Hey everyone, it's Andrew. Welcome to Atomo. It is Friday, March 31st, 2023, and there are a few things going on here. Let's get the screen up and running. Coming in now. All right, let's go to Italy. Madame Madoni, I don't know how to say it in Italian. I don't speak Italian. What I wanted to take a look at here is appears that Maloney is creating a firewall in her retail and investment banks. So yeah, so here we go. Radical overhaul in the country's banking sector. Um, so on the details of the Credit Suisse problems that have been going on. So the thought here is that she's looking to have the banks shore up their risk exposure. And the thought here is, just looking through this, so allowing retail banks to engage in speculative trading is dramatically negative for the real economy. Okay, so this is what we've seen quite a while ago before 2008, 2009, and back when the United States had the Glass-Steagall Act in place, where you couldn't commingle your investment bank funds with your vanilla deposits, in which when Glass-Steagall was brought down, then there was the ability, okay, I can bring those two sides together and start to mix the monies up. So basically, as the near zero interest rate happened when we had the zero bound was arrived at, then, well, how do you make money in that environment? Well, speculative trading on the stock market is a way of potentially doing that. And in order to keep goosing and goosing and pumping more money in, you go over and you just rob your depositors, essentially. With what is happening from the Federal Reserve side by them raising rates, in order to gain yield, then you have leveraged groups like BlackRock, for example, going out and taking riskier assets into their portfolio and charging a higher nominal yield on that as they do that. So that means what you saw with Credit Suisse could potentially happen with other banks. And it looks like what the Italians are doing is saying, okay, we think there might be systemic risk. Now, again, no financial advice, no legal advice, medical advice here. This is just speculation, is that this contagion that's going to start moving through Europe can potentially impact these banks. Now, is it too little too late? That's what we need to see happen. Pretty much USA is in a good spot right now with the break from LIBOR. So for LIBOR break has happened, I think that should complete sometime in June to complete cutover. But the Chicago Mercantile Exchange is not allowing, I believe, as of April 14th, you can no longer trade LIBOR futures. So that just means that there will be changes coming in Europe as these elements start to unwind through the system. Okay. Next up, we got another one here in the form of JP Morgan. Now let's take a look at a couple of things. All right. Here we go. So there's JP Morgan, Goldman plan to start trading private credit loans. Oh, interesting. Okay. So declined to comment on the report when contacted by Reuters. JP Morgan, Goldman Sachs Group looking to start trading private credit loans. Okay. Had Bloomberg News reported on citing people familiar with the matter. So there's insiders that are saying, hey, guess what we're going to do? Yeah, private debt funds about facilitating secondary market transactions. Oh, okay. So what we're seeing here is, that's kind of a short article. Let me jump back to here. Let's go to another one. Yeah, here's something. So if we're looking at, okay, here's a table of assets under custody by global custodian, and this pulled off of Wikipedia. But the sources check out. But even if we're not accurate to you got 3 significant digits showing up here for most of these. So first thing to consider is, oh, CBD, central bank digital currencies, CBDCs, they're going to come, they're going to take us all over. Like, okay, caught that, saw wind of that signal coming through for the last while now, over a year or so. Would you think that with all of these, my joke is asset under the cushions, so all these big sofas that these banks have and all the trillions stashed into those cushions, do you think they're just gonna pick up the furniture and say, well, here you go, IMF, here you go, ECB, yeah, go create a central bank digital currency and rule the world, because we know the Europeans just love to tend the garden, we're the jungle, and we should feel bad for that. No, you good Europeans know how to take care of this. No. So this is what you're looking at here is allegedly the kind of the power behind Jerome Powell and what he's doing right now. It makes savings great again. And as the regional banks start to have problems, then look at the amount of potential collateral. Now, I don't know whether it's, tier 1, tier 2, tier 3, capital that you can pledge, and then so on and so forth, and build loans off of that. I'll leave the technicals to these players. There's a lot of money with these players. And if the regionals start to blow out in the USA, what we are potentially seeing here is that, first of all, there's an opportunity. What's the opportunity? Well, I can lend out money. You can either go to the Federal Reserve and take the too big to pivot, joke, TBTP faculty that they have, as long as you have the assets on your books prior to the date. I think that was March 13th. And you pledge those at the window to get your, so if you, as I said before in other videos, you pledge this illiquid capital that you can't convert because you have to hold to maturity, especially some of these treasuries. But you can go to this window, you can hand in your treasuries and you can get a loan, but that loan is at your Fed funds rate plus 10 basis points. And you have to pay it within a year. So you can give the Fed, you can take, okay, well, if you're going to charge that rate, so what if JP Morgan is going to provide me a compelling rate lower than the Federal Reserve, and I don't have any sort of stigma of going to the Federal Reserve? I just have JP Morgan underwrite the loans that I need to keep my bank running. And potentially at the same time, if they got a good suite of advisors, might bring on an advisor to the board to help to clean up, given that the banks really want to clean up because they see the game that's afoot. And Powell is basically putting the bullet to the Fed put. And with that, the banks need to up their game because depositors are just going to go and find, well, if you can get 5% on your money sitting in just a deposit account, they're going to go and they're going to find now savers are made good again. Saving can be a thing. You can go out and you can potentially get 4 5%, depending on the saving instrument, or locking it into a fixed deposit, instead of it getting like pennies on the dollar sitting in the savings account, because the banks, because of the way that the rates went up, they just can't react to it fast enough. But people can move faster than the bank can react to it. So here's a market opportunity for these folk here. So as banks do, they're going to find the opportunity to make some additional money on this. Can't fault them for it. It's not QE, it's not creating new monetary units, essentially, because it have to put up some sort of collateral in order to back the loan. So while maybe they can get ratios on the reserves, there's no new monetary units entering the market. Going back here, now let's pivot over to this talking point here. Okay, so Bank of Japan's new central banker, next big threat to global financial stability. Depends on what team you're on, Bloomberg. Depends on what team you're on. Now, if you're for Team Europe, Team Davos, then with the previous Bank of Japan governor potentially holding up the German yield curve, so that Lagarde gets some leeway to do whatever she needs to do in order to shore up the Japanese, or not the Japanese, sorry, the European banking sector. I'm going to jump over to this thing that I made up here. So this was back a couple weeks ago, I guess. And when there was that changeover at the Bank of Japan, just look at them, just yeah, we're not playing this game anymore. We're not letting our yields fly out like that. We're reining it in. We're going to get serious about our fiscal discipline. And yeah, oh, look at that. Oh well, the game's on. The game's on. So those are some things to expect coming up. You got the Bank of Japan, potentially now getting serious about slowing down or to start their quantitative tightening. Remember, it was beggar thy neighbor when Bernanke started quantitative easing, then carry trades were potentially erupting. So, hey, we're going to jump and find the currency that we can arbitrage on in order to make some money. And then Bernanke saying, well, no, don't beggar thy neighbor. So the ECB has to raise when the Fed raises, and Bank of Japan has to raise. Bank of Canada or print, getting locked into raising because that's what's happening now. But it was print, all the main central banks back at around when they started QE 2010, 2011. Then Bernanke, if you look it up, the beggar thy neighbor conversation he was having. So yeah, now we're seeing the reverse, where now the central bank's like, oh, whoa, we kind of have to do this in unison now. But Fed went first, so that means Fed gets its first mover advantage to start to raise the price of US dollars. Another part of that is Jerome Powell is trying to get some sort of control over the euro dollar market. You just, how much liquidity is sloshing out there that's underwriting all this cheap stuff that's going on, not providing any meaningful value. So it's time to pull the rug on the zombies and just bring everything back to kind of a stable game, back to the good old days of we're able to save now, and looking at how bond traders like, oh, how do we trade a bear market in bonds? This is a new thing. Unless you've been around, oh, what's that? Possibly since the 80s, after Volcker did his thing. Um, yeah, so might be going back to a lot of the fundamentals that we kept talking about that got blown out when QE started. So that's some of the things that are happening. Again, assumptions here. Don't take this as financial advice. Just stay safe out there.